What's up, guys? Eric here. I want to bring you a total of 6 stocks to buy today. According to Seeking Alpha, these are growth stocks. Before I do that, let's talk about why the market's pulling back a little bit and where it could go from here. You can see in the April sell-off, we got all the way down here to 48.35. Now, what's crazy about that is that goes back to January of 2022. That's the end of the pandemic bull run. And then we ripped from 48.35 all the way up here to almost 6,000 on the S&P 500. Now, that's a 23% pop in about a month from those lows. So of course that could lead to some profit taking. On top of that, you have treasury yields hitting 52-week highs today. You can see the US 30-year treasury here at 5.08%. So it is pulling back slightly, but the low on this in April was 4.33%. So a massive rally. And you can see in the last 5 years, the only time we were at that level was fall of 2023, where we did have a sell-off, especially in growth stocks. So what are the repercussions for higher yields when it comes to stocks? You're going to have higher borrowing costs for companies as well as greater investment competition for fixed income. And part of this started with the Moody's downgrade that rippled the bond market. And then on top of that, today, House members approved a bill that lowers taxes and additional military spending. The bill, which now goes to the Senate, could increase the US government's debt by trillions and raise the deficit. We're trying to go the other direction. So short term, the tax bill is good for the economy. It's going to boost GDP growth in 2026. It reduces taxes for lots of people, increases spending, especially on defense. And of course, that's going to stimulate the economy and boost GDP growth. The problem is that longer term, it blows out the deficit. Long term, it's bad for the market. It's bad news. Yields are going to go higher, which means prices are going to go down because treasuries are becoming less appealing and trustworthy as our budget deficit stays extremely high for a very long period of time with no signs of it going back to normal. So this right here puts stocks in a very difficult position. Now, currently, the S&P 500 has 5780 support, and with that support, you could see 6,000 and 6150 in extension, and the Fibonacci R3 is 6226, so it's possible to see new all-time highs this year. You can see that 5780 is roughly around this 100 and 200-day simple moving average. If it breaks that, possibly 5695, and then the 50-day simple moving average, 5576. And of course, the big line to hold here is 5500. And you're thinking, well, that's great, Eric, but you want to know what are the best stocks to buy now? And of course, if you bought any of these April buys, these are stocks we recommended on this channel, you're doing very well. So are these the best stocks to buy right now? Or do you have to shift your focus? I'm going to bring 6 stocks that are buys according to Seeking Alpha right now. The first stock, if you're doing a screener for growth on Seeking Alpha, is going to be AppLovin, not McLovin, AppLovin, ticker APP. We've talked about this on the channel. We recommended it when it was closer to $200 a share. We're up 75% on this in the community portfolio. Profitability metrics are very strong. Of course, they've been growing that subscription model. The growth grade is also an A+, and these metrics get really impressive, especially when you start looking at the EPS gap growth. So earnings per share gap growth year over year, 362%. I mean, check out this revenue. 1.48 billion, increase of 40%. Adjusted EBITDA, increase 83% to over $1 billion. And it's really growing into an advertising powerhouse. It grew 71% in advertising and decreased on the apps. Cash flow generated $832 million of net cash from operating activities, $826 million of free cash flow. That's impressive. So if you're looking for a growth stock, this could be your huckleberry. These numbers are trending up nicely. Now, valuation-wise, it shows a D+, but we're talking about some amazing growth with a forward gap PE ratio of 45. So even though this stock has ripped 350% in the past year, it's not crazy expensive compared to a lot of other stocks. Now, with that said, that market cap is $121 billion, so it is getting much larger. So this stock bottomed at $200.50 in the April low, and it's rocketed all the way up to about $380, and it has pulled back to about $360 now. The all-time high was $525 a share, but at the same time, this was a $25 stock just back in June of 2023. So a lot of money has been made on this stock. You're talking about a 10x from $35 in September of 2023 to today's prices. This 200-day moving average is around $250. I personally would want this to come back a little bit. You are above the R3. This 100-day simple moving average is 324. This is one that you have to dollar cost average in, and of course, the lower, the better. Be aware. This next stock has earnings on Monday, June 2nd, which could make it pop or drop. Credo Technology Group, founded in 2008. And we've covered this on the channel before, but this is going to be a pure play AI data center name. Hyperscale data centers and AI, driving unprecedented need for bandwidth. And that's what these guys are all about. It could use some work on the profitability metrics, but that gross profit margin is pretty strong at 63.71%. The growth is rock solid, got an A+. Valuation wise, it gets expensive. Now, this is a forward gap PE of 222 and a forward price of sales of a 24. This is a $10 billion market cap. And this is where people will say, hey, it's small, it's growing into itself. It could easily be a 10x type of a deal. You have to be careful though, because it is up 216% in the past year. And this was a new IPO listing, January 26, 2022. Now, if you follow this channel, I've talked about this company before and I don't own it. And the reason for it is it's headquartered in the Cayman Islands. It simply doesn't fit into my list, my rules of engagement. Doesn't mean it's a bad company necessarily. I just do what works for my money. You do what's best for yours. Like a lot of these AI names, we really had a bubble, huge air pocket here. It's $86 stock. It went public for $18. You could have bought it for $7.20 back in May of 2023. Rips to 86, comes all the way back and fills that air pocket. It bottomed at $29.09 a share, from 29 to 60 plus. So this is another one past the R3. I personally would not be buying it right here, right now. I would put it on my watch list, and if it pulls back on earnings, it could be an opportunity to buy. Now, I actually got made fun of for this pick on the channel, and it's up something like 25% since I recommended it. If you haven't looked into Seagate, they're actually kicking some major behind right now. In fact, they're supporting nearly all of the world's cloud and edge data centers. Now, these edge data centers are going to be huge when you think of AI inference. And this is a great infographic here. So this is the client server era. This is calendar year 2005. So think Hewlett Packard and IBM and Dell. And then we have the mobile cloud era. This is calendar year 2020. So Google and Apple and Facebook and AWS, Netflix. And over here, you've got calendar year 2028. And this is the AI era. Now that infographic is showing zettabytes. To put it in perspective, it's 1 billion terabytes or 1 trillion gigabytes. It's an enormous amount of data. So we went from less than 1 zettabyte to 72 to 394 generated in calendar year 2028. Now, of course, this requires storage, and that's where Seagate comes in. Another way of showing it here, you got a 20%, mid 20% compound annual growth rate. And if you do some research on this stock, the ticker is STX. Look specifically at this technology right here. And this provides powerful density at scale. You're talking about 40% improvement. And the numbers are quite good here. Dividends as well as cumulative shares repurchased. So dividends are in the blue. The green is going to be the repurchases. So you got an 11% quarterly dividend raise, over $4 billion of free cash flow generation, an 18% reduction in shares, over $7 billion of cash returned to shareholders through dividends and repurchases. And to top it off, just today, this morning, Seagate approved another $5 billion share buyback. The stock is up 3.49% on the news. An A+ growth rating for a dividend-paying stock. Now, even after a significant pop from the lows, this is still paying you a 2.76% dividend. Now, historically, this doesn't carry a huge premium, but still attractive at 15.8. That's the PE gap forward. You can see it got down to $63. It ripped all the way up here to $111 a share. The recent highs here are $115.32. So I own this in the dividend portfolio. I started buying it somewhere in the 80s. I dollar cost average all the way down. I'm up about 29% right now. So it's tough. Again, a lot of these stocks, you miss the bottoms, you miss the best prices, but what are attractive stocks to buy for the long term? This benefits from AI and pays you a 2.75% dividend, so it is quite rare. Of course, remember that storage and hard drives, generally that's a commodity. So you're not gonna have huge profit margins like you would on software. This carries something closer to 35% gross profit margin. So STX comes in at number 3 for the best stocks to buy, growth stocks to buy right now, according to Seeking Alpha. Number four, I've been big on this one for a while, guys, and it got absolutely destroyed in April and back to $96 a share. This is Astera Labs, ticker ALAB or ALAB. This is a $15 billion market cap company. It's still down 27% year to date. Profitability, very strong gross profit margin at 75%. This is hardware, another AI player. Revenue growth is rock solid. You can see A plus 200%. Not a cheap stock, very similar to CRDO, 174 on that forward gap P ratio. Price to sales forward is a 21. So the preference has been $65 or less DCA for ALAB. So $65 is the top of this yellow circle, and it got all the way down to $47.13. It then rocketed from $47.13, trading right now at almost $97 a share. This is 100% returns. This was a new IPO back in March of 2024. It dropped down here to 36 bucks and rocketed to 147. So this stock lost $100 from its highs. Now, this is the second largest holding in the community portfolio. I don't own it in the main portfolio. And if you just bought it heavy, like we did in Discord at these lower prices, you're probably not buying it close to $100 a share. With that said, I see upside of $125 possible this year for the stock. Of course, as a high flyer, earnings are gonna have to deliver. This could get crushed. It could be one of those that pops or drops 20% on earnings. But again, guys, I'm bringing you the list, the top 6 growth stocks to buy according to Seeking Alpha. The highest price target on this is $120. The lowest is $75, so tread lightly. Micron was way overextended, $157 a share, and it dropped off a cliff. Like a lot of these stocks that were tied to AI, all the way down to $61.54. So this is another one that dropped almost $100 per share from the highs to the lows in April. From that $61.54 low in April, it's ripped up to about $99 a share. So it's getting some resistance around $100. Now, the average analyst price target is $125. So it's about a 28% return from here. If you look at the valuation metrics for Micron, they're not crazy expensive. The forward gap PE ratio is a 15.08. But keep in mind, this stock typically doesn't carry a higher premium if you look at that historic PE. This does pay a small dividend, 0.48%. Now, again, I was buying the lows heavily in April, so I'm not buying Micron right now, but this is a high quality company that does benefit from AI and does have upside from here if you're a long-term investor. Coherent, ticker COHR. This has solid growth. It's about a $12 billion market cap. I've covered this one on the channel before. If you want to learn more about this stock, I've got a video link in the comments below. Go check that video out. You can see, like most stocks tied to AI, it was a $113 stock, fell all the way to 45. Now it's back to 80 bucks a share. So another amazing opportunity to dollar cost average in these April lows. If you're buying these prices, I'd consider it speculative, but I still like it at $80 a share as a long-term investment. If you're new here and videos like this are helpful, make sure you subscribe, click that bell for notifications, and drop me a like, drop me a comment. Thanks for watching. Have a great rest of your day. Take care.